Wall Street moved with a sense of caution today, as the mood on the trading floor shifted from optimism to uncertainty. Investors pulled back amid growing concerns about the market's direction, choosing to step aside rather than take unnecessary risks. On October 14, 2025, all major U.S. stock indices declined, reflecting widespread hesitation and a collective pause among traders. The Dow fell 152 points, marking a notable drop that caught the attention of seasoned investors and newcomers alike. The S&P 500 dropped 38 points, adding to the sense of unease as analysts debated whether this was a short-term dip or the start of a larger trend. Meanwhile, the tech-heavy Nasdaq slid 189 points, tech stocks taking the hardest hit, as investors questioned the sector's near-term prospects. This wasn't panic selling, but rather a defensive move as investors weighed mixed corporate earnings and awaited key economic data that could shift the market's direction. The day's declines weren't triggered by a single event, but by a blend of underwhelming earnings reports and anticipation of upcoming inflation numbers, which could influence future interest rate decisions. With so much unknown and volatility on the horizon, selling felt safer than buying, and caution ruled the trading floor as many chose to wait for more clarity. The market's mood was clear: wait, watch, and avoid risk until the bigger picture becomes clearer, as everyone searched for signs of what might come next. Third-quarter earnings painted a mixed picture for investors, revealing both opportunities and challenges across the market. As companies reported their results, some sectors managed to shine while others struggled to keep up, highlighting the importance of looking beyond the headlines. Healthcare stood out. Johnson & Johnson and United Health both beat expectations, lifting their stocks in the sector overall. Strong demand for medical products and services helped these companies outperform, giving investors confidence in the stability of healthcare even when other areas faltered. Even on a down day, demand for healthcare proved resilient, offering a safe haven. Investors flocked to these stocks, seeking protection from broader market volatility and uncertainty about the economic outlook. In contrast, financials struggled. Bank of America and Morgan Stanley both fell after reporting, as concerns about future profits and deal-making weighed on sentiment. Rising interest rates and economic uncertainty made investors wary of banks and financial institutions. The market rewarded steady, essential businesses and punished those exposed to economic swings. Investors favored companies with reliable earnings, while those tied to the ups and downs of the economy faced selling pressure. This selective approach shows investors are carefully choosing where to put their money, not abandoning the market entirely. Instead, they're focusing on sectors and companies that can weather uncertainty and deliver consistent results. It's a reminder, not all stocks move together. Sector strength matters, and understanding these differences can help investors navigate changing markets with greater confidence and clarity. Inflation fears loomed large, with investors bracing for key reports. The Producer Price Index and Consumer Price Index, due later this week. These numbers will shape expectations for the Federal Reserve's next move on interest rates. If inflation stays high, the Fed may keep rates elevated or even hike again, pressuring stocks and the economy. A cooler report could spark optimism for rate cuts ahead. Until then, uncertainty keeps investors on the sidelines, unwilling to make big bets. Today's sell-off was a preemptive move, reflecting anxiety about what's next. The market is holding its breath, waiting for clarity. Rising Treasury yields added to the market's woes, with the 10-year note climbing to 4.63%. Higher yields make bonds more attractive, drawing money away from stocks, especially growth and tech names. That's why the Nasdaq took the biggest hit. Global worries also weighed on sentiment. Geopolitical tensions and signs of economic slowdown overseas threaten U.S. corporate profits. Instability abroad can disrupt supply chains and dampen demand for American goods. The combination of rising yields and global uncertainty created a tough environment for stocks. Investors are wary, watching both domestic and international risks. The headwinds are strong and optimism is in short supply. For everyday investors, today's market drop is a lesson in caution, not a cause for panic. It's natural to feel uneasy when headlines are filled with red numbers and uncertainty, but it's important to remember that market downturns are a normal part of the investing journey. These moments can actually offer valuable opportunities to reassess your strategy and make sure you're on the right track for your goals. The split between strong healthcare stocks and struggling banks shows the value of diversification. When one sector stumbles, another can help balance things out, reducing the impact of sudden drops. This is why spreading your investments across different industries is so important for long-term stability. Owning a mix of sectors can help cushion your portfolio during turbulent times. By not putting all your eggs in one basket, you're better prepared to weather unexpected storms and take advantage of growth wherever it appears. The focus on inflation and Fed policy highlights the importance of patience. Trying to time the market is a losing game. Instead, staying invested and keeping a long-term perspective can help you avoid costly mistakes that come from reacting emotionally to short-term news. Stick to your long-term plan and avoid knee-jerk reactions to daily headlines. Remember, successful investors are those who stay calm and disciplined, even when the market feels unpredictable. Volatility is normal. Markets move up and down as uncertainty ebbs and flows. Over time, these fluctuations tend to smooth out, rewarding those who remain patient and consistent. Understanding the forces at play, earnings, inflation, interest rates, can help you stay confident. The more you know about what drives the market, the less likely you are to be swayed by fear or hype. The key: stay informed, stay diversified, and don't let short-term swings shake your resolve. By focusing on your long-term goals and making thoughtful decisions, you'll be better equipped to navigate whatever the market brings.